All right, let's get straight into today's video. It is not going to be a long one, right? Not going to be a long one at all, just purely based on where we are in price and the fact that you need more information in order to be able to trade with a high probability. Where we are right now, in my opinion, is the most uncertain as to where price will be for quite a long time. But nonetheless, we will get straight into it. So before we take a look at where we've been currently, or where we are, what we're doing, let's just take another step back and take a look at last year's accumulation, manipulation, and distribution, or rather last year's potential AMD upon our retracement. Okay, so I'm not quite sure why this doesn't show up here. It's probably just because I'm on top step, but it doesn't matter because we only need these levels here. But what I wanted to take a look at is our standard deviation projections, because that is how you trade in all-time highs. I'm going to keep it real with you, keep it simple. That is exactly how you trade all-time highs, utilizing standard deviations, the central banking dealing range. All these different things are required in order to be able to successfully and with a high probability have good targets topside when we are already above all-time highs, sort of thing. So nonetheless, we'll get straight into it. Again, my standard deviation projection tool, pause it if you need it, but we are going to look at this now. So this is last year's price swing, right? I'm going to do it on the daily because it's more precise. I have looked at this previously many times, but we have this range here. So we have a range low to range high, which actually I'll draw the bodies because that's our true range. And I'm going to draw again the bodies here and here because that is our range. When I say range, I mean, again, today isn't going to be long. It's just going to be pretty to the point, less educational, more straight to the point. A range is clearly defined by a range high and a range low. So yes, you can draw the range high and range low out, which gives you an okay standard deviation projection. When we're looking at such a high time frame, I like to personally just take the bodies. For me, it adds a layer of precision where we can see, like, here standard deviations are aligning with each other and so on. But these standard deviations we'll look at slightly later on a daily time frame. That is just figuring out how to find them for that. For the daily time frame, again, just things to note for the weekly is prior week has closed as a bullish expansion. That means we now have this weekly gap in here, which has been left unfilled. We also then have new week opening gap high, which I'll mark out here, NWOG high, NWOG H, which I don't like that color, nor do I like that color line. And then we're going to mark out the new week opening gap low, NWOG low, prominent looking gap. We'll get more specific on that in a moment. But my initial narrative that I wanted to see play out was this unfilled fair value gap get traded into following an inversion of this unfilled fair value gap. So, has that occurred? No. Did we react off the level that I wanted to see us react off? Yes. Should you have bought some stocks in there? Yes, most definitely. Most stocks were actually below in discount and they were lagging anyway, so actually would have been an incredible buy there if you did. I really hope you guys did. But even still, this was the primary target. Does it matter that we didn't get it hit? No, not at all. This was still our first lowest hanging fruit on the weekly time frame. What do we remember me saying? Low resistance liquidity run up until here. Our reaction here will either drive price lower or we will get our bounce like we did here. So now with that understanding, it's the exact same here. We're going to drop down to a daily time frame. Again, I'm sorry that you can't see over. All right, I'm sorry that you can't see over to the left as much here. Yes, more of it's spawning in as we drop timeframes, but our standard deviation, because remember, if you've watched my videos, you'd see smart money reversal, flip of the curve, buy side. We are trading the change in the state of delivery. That is where our standard deviation goes. If you don't know what that is, just go have a look. And it's the exact same. We can see here, we start to reaccumulate, start our upwards of reaccumulation. And we can see 2 to 2.5 precision, absolute precision. That's where we get our primary rejection off. And that's exactly where price looks to trade to for our all-time highs. But again, it makes sense because of this liquidity pool. But did it make sense when we didn't have any of this price action? No. Do the standard deviations make sense? Yes, they always do make sense. 2 to 2.5 is always the best reversal. 1 is a likely reversal. It just means it's a perfect swing of our change in the state of delivery. That means we are likely to get a push to this leg, yes. Doesn't mean we are guaranteed to go to 2 to 2.5, no. When we do, this means that we are likely to then reverse. When we get to 4 standard deviation, that means it's a overextension of price, all right? We can look at that same standard deviation from here. No, we didn't go to 2 to 2.5. If you drop down a time frame and get more specific with your levels, it does start to paint more of a picture. Like there's our 4 standard deviation. We have then a reaccumulation up here with a cleaner standard deviation projection again, where we get a reversal, and then you can look to keep trading that. But even still, I only really like the daily just because of this, because it's how precise this one was. So again, it's the same thing. Going to draw up our standard deviation from below to where our change in the state is. I'm going to draw it up from this level here. Prominent reversal points. Do these still align? Yes. Are we still within this higher time frame, which is over to the left? Are we still in this higher time frame area? Yes, we are. Does our new standard deviations align with it? Yes. Are these now high probability draws on liquidity or time and not draws on liquidity necessarily, targets for liquidity to hit? Yes, they are. It is even nicer if they can align with exactly like that, like a perfect level. What do I mean by a perfect level? Like a 2,700 level, like a 2,800 level. The market, for some reason, loves to close and react off of these perfect levels. It's very weird how that happens, but still, that's what the market likes. It must be something to do with individual human psychology or mass psychology even, but regardless, these levels are our key, where we want to see price trade to and react off of, sort of thing. In between these ranges here, yes, you can grade them with your equilibrium quadrants, however you like to do it, optimal trade entry, so on. But this is what I'm looking for when we're in all-time highs. And the exact same thing applies for, say you're looking on a 15-minute time frame. All right, where's our hourly time frame? Where's our most recent accumulation manipulation? It's the exact same thing we have here. We are at 4 standard deviation, an overextension of price. So what do we get? A gap lower. We go then sweep liquidity, and then we can look to trade higher off of the exact same sequence. This gap manipulation leg, I know this one isn't as precise, but even still, manipulation leg, a change in the state of delivery. 2 to 2.5, we start to reaccumulate. 4 is our overextension in alignment with our perfect delivery or perfect number. This is what you need to be doing in order to have high level, high probability targets. It's pretty simple, all right? There's genuinely not much more I can cover in relation to higher because it's an uncertain time. That's just the nature of price. Once we get there, which we have cleared all-time highs, there is potential that we do that. Now, what am I looking for? What am I as an individual specifically wanting to see? So we obviously have this huge new week opening gap. We have this, let me fix this up. Let me get rid of these old gaps and things like that because it's too far away from where current price is. Weekly unfilled BISI. So as of right now, it is a, sorry, I was just checking to make sure that it was actually this microphone I have here, not my laptop or webcam microphone. But, so, we have we have our equilibrium level. Why I was messing up just then is because that equilibrium level doesn't actually mean anything. Yes, we have a discount fair value gap beneath it, but that level doesn't mean anything yet. So why doesn't it mean anything? Well, until we have a candle, say these are just white up close candles, until we have some candle close bearish. So let me, even just for the example, make these white. Sounded bad. Say these are white. Until we have a down close candle, so just for example like that, until we have a down close candle, I will not be drawing up equilibrium. Until we have a down close candle, I will not be drawing equilibrium expecting lower prices. Because until there is a reason for price to reverse, which again, that's not a reason, but a swing point being created on the daily time frame, that is a reason. Now, for me, it's even higher probability to be looking for that retracement if we can get a sequence anytime. It doesn't have to be this week. It doesn't have to be the week after that. It could be the week after that. We could have genuinely months of expansion with zero retracement. Yes, the economy thinks, when I say the economy, mass human psychology currently thinks that we are going to gap lower. Why? Because Trump said some BS about the Strait of Hormuz being open, and then Iran came out and said the complete opposite. So what does mass human psychology believe? To gap price lower. What is then likely to occur in the chart? What have I taught you throughout this whole sequence here of price gap lower? Or let me explain it. Price gap lower. Everyone believes Trump will say something over the weekend that is super bullish or super bearish, sorry. So we gap lower. Then what happens? FOMO. Everyone starts shorting in here. So what do? Smart money goes and runs out everyone in here and manipulates them into thinking price is going higher. What then happens? We then go stop them out. What do we get the next week? We get a gap lower. Oh, it's going down, it's going down. We then get a run higher into our inefficiencies that we've created that prior week. And then what? Everyone starts FOMOing longs. Oh, it's doing this, it's doing that. Trump's saying this. The news is saying that. CPI's done this. Then we go run them out again. Same sequence. Gap lower. Go stop them out, and so on. And you can see it here. Like, it doesn't look like clean price delivery, but it actually makes so much sense. Gap lower, stop everyone out, distribute lower. Gap lower, stop everyone out, distribute lower. Gap lower, stop everyone out, distribute lower. It's on repeat. So until we get something that's like pretty clean like that, I probably won't really be like favoring shorts that much. I know shorts for me personally, I'm sure if you just watch all my videos, you hear me say, I'm in shorts, I'm in shorts, I'm in shorts. It's something that I favor towards. It's proven in my statistics that I favor towards shorting the market rather than longing. But where there is no reason for price to reverse, I have no reason to be bearish. Again, 15-minute lower time frames may be different. This is understanding the total market. This is much deeper than understanding an intraday understanding. This is understanding why price does what it does, when it's going to do it, and why, and how. So, per se, we have the market gap lower. Before we truly have a run lower, I would want to see a resweep of these highs. So say price gaps lower, I'd want to see price come up, take those highs, and then run lower. So like an actual smart money reversal. If price gaps higher, I then pretty much want to see like either a dip below and then a continuation. If price gaps higher, we don't need to do that. We can just continue. But until we have that down close candle put in, which for me, it will be perfect if it does it like that's an up close, and then we get a heavy down close. So we sweep the high with a heavy down close. No opportunity for retail to get out. When I say a heavy down close, either closing below that candle, just so long as it closes below the candle that's either put in the high, or if it's swept the candle that's put in the high, so long as that one closes bearish by itself and closes over these two, or that one that was previous to it, that is a good sequence to then start looking for equilibrium, okay? When I say equilibrium, it's less equilibrium, it's more like discount arrays. So right now, these are all premium arrays, yes. They are all weekly premium arrays. Are they unfilled and are they ranges in which price can and potentially probably will react off? Yes. Is price likely to get down below here? Less likely, in my opinion, much less likely. What does that look like? That looks like balanced price. What does this look like? That looks like balanced price. The bit that looks inefficient is low-key just this last bit, which even still barely looks inefficient because we are overlapping what has already occurred to the left side. If this is low resistance liquidity run, what does that mean? Price can run it like it's low resistance liquidity, speed and distance. It's very, very, I won't say easy because you guys don't see it that way. It's not easy to you. It is actually pretty easy to me. Just like understanding why, like standard deviations, simple. 4 hourly to gain more precision than the daily. What do we get? 2 to 2.5. So let me get rid of all this other mumbo bajumbo. 2 to 2.5. Prominent reversal point. What do we then get? A gap to an overextension. What do we then get? Retracement for more liquidity. Then we start playing into a higher time frame narrative, which is then our daily. It's pretty easy. But again, it's also not like here we probably just get a perfect swing of the price run we created, which perfect swing. It's the same thing. Which is why I kind of am not going to do too much lower time frame, like 4 hour, 1 hour. I just wanted to help you, all of you who watch this, understand the market in which we are about to be trading into. So for you traders, which are all ICT traders, I believe, like I can't know for certain, ICT works the best in expansion, not in consolidation. The reason why every ICT trader, not me, not every ICT trader, but the majority were getting stiffed in this area and then started to see success or started to see their probability of concepts playing out is because price was in consolidation rather than expansion. Manipulation is also expansion, by the way. Like quick delivery of runs, that's expansion. But that is when ICT concepts work the best. So what you need to understand is, one, don't be trying to pick the high. You don't catch a falling knife, right? That analogy works for if price is trading higher. You never catch a falling knife. You never pick the high of a building that is still being built, right? It's very simple. So what are we going to do? What are you going to do? You're going to wait until price puts in a down close candle. Yes, you can still trade. You can still keep taking your longs on market open, doing whatever you do. But I want you to know that we won't have anything true or meaningful until we have a daily candle close bearish, like truly bearish, right? The 1 hour and 4 hour, like it doesn't even matter. Just look for confluences for higher. It's pretty simple. Okay, I will say there's a bit of uncertainty for me specifically for not wanting to trade potentially Monday. You just need more information. We just took all-time highs. Can the market reverse? Can the market dump? Can the market gap down here? Yeah, it can do all those things. Is it probable to do so? That's up to the elements. What you as the individual need to do and understand is that the more information you see upon tomorrow's open, upon Tuesday's open, upon all these different key times and levels, you need to start to put the pieces together of more information. Are we going to just continue or are we going to reverse? And what does that look like? All right, we've got these hourly gaps, we've got these daily gaps, these 4 hourly gaps. So all you've got to do is see, and again, only draw up bullish gaps right now because that's all you want to see if price is respecting. You don't want to see if price is respecting bearish gaps right now. You want to see if it is respecting bullish gaps, and if it's not, why is it not and how is it not? Are we trading in the bottom half of the gap, accumulating into the top half and then manipulating lower? And then say we have a daily close where these are then in alignment for us to then continue our delivery down. Once that all makes sense, then it's okay to do so. Then it's okay to start looking short. But until we have a reason to, you want to see damage in the top half of these gaps. So when I say damage, that just looks like this, like wicks going into the bottom half, the body's respecting the top half of the gap, right? That's what damage means, okay? So the wicks can do whatever. The wicks can go through it. I call these mohawks. To be honest, the bodies can go through it too, like that, and leave long wicks, which most people would call an inversion. That to me is a mohawk. Unless you have true conviction of like a down close like that through it, it's not an inversion. It's not real. So you want to be seeing something like this and then you want to see price trade out of it, okay? If price doesn't do that and we continue to do this, you wait. You wait until you see what price does. Once we get that, all right, we're probably going lower. If it's just if the next candle then does that, now what are we going to do? We're going to continue our directional bias higher off of an accumulation, manipulation, distribution. Again, it all makes sense. But if we then get this and then another candle down close, this is no longer AMD. This is now a reversal, okay? So what you want to be seeing is this, is again what I've just shown you here. But on top of what you want to see, you don't want to trade that. That's the other thing. You never really want to trade that. You want to be trading the candle that you know is going to make the expansion. How do you know if it's going to make the expansion? Well, probably an internal sweep. Normally when we have like a fair value gap like this, if you get a low put inside of it and then all the other candles don't like actually take that low, and then you get one that does take that low and you get a SMT off that low, that's the candle that's going to make an expansion almost every single time. Like, let me just try find, like, I know it shows up more frequently on the hourly. So like this. Yeah, this is probably a good example. So we have, again, it is like relatively similar over here anyway. This is more so like a 15-minute, but even still, it's super high probability. So we have a fair value gap, have an hourly here. We have this low that has traded inside the fair value gap. And this is still just reaccumulation inside this wick high and this wick low. So the one that's traded into liquidity and the one that's traded into liquidity. When I say traded into liquidity, a fair value gap is internal liquidity because again, it is just a lower time frame prominent swing point. What I mean by that is if I look at the 5-minute where I just drew that line out, we can see that's a prominent swing point there. Less prominent on that example, but you get the point. It's liquidity, top side, it's swept liquidity. So we're trading in that range. So how do we know? We're never really kind of just going to create a range and then break out of the range. What are we kind of going to, sorry about that. What are we going to do? We're probably going to manipulate the range lows before we go trade higher. That's like a common thing in expansion markets. We are going to stop people out before we go deliver to our targets. It's the way that the market moves. So you can see we have this internal low resting inside. We then get that sweep. We then get a candle closing outside of that prior candle's body range. And then we have our expansion. Start to kind of make sense. Even in here, I'm sure if I scale timeframes, it's going to be the exact same thing. You get a low created inside of a fair value gap. You get like a resweep and then you start to have your displacement. That's why resweeps are quite important for understanding the market. But even still, this is enough. Like, say inside of our 4-hourly time frame, we have this 1 hour. Those are fine to say there. So say we have that 4 hour, we have this 1 hour low inside of this 4-hour gap. So say that's our 4 hour. If we get a sweep of this, say we have a candle trade in, we then have another candle, and then we get a sweep of this low, say an SMT from here to here. Just for the purpose of this, I'm going to make it cleaner. I don't want to confuse anybody. Hope everyone's day's been going well. I hope you guys are enjoying this video. I said I wasn't going to do EDU, but there's not really much market analysis to be done. It is kind of just being patient, seeing the things that you want to see. But yeah, so we have trade into, and then on our third one, so a 3-drive pattern, we then sweep the low, all right? It's even better if we can get divergence between NQ and ES at that low. But then what we normally get is we get some kind of reversal where we don't actually go take this high, kind of like the example I showed you. So now we have this intra range where we're kind of trading inside of it. We're doing whatever. This range to me is only completely invalidated for like for higher when we like take the range and then have a reversal. Like, you can't like know for certain we're not going to continue price until we've broken out either side of the range. So what we want to see, if we know that this was normally probably accumulate, we want to see price trade lower first, stop anyone out that's entered in this, offer smart money a final entry long before the market is going to run. So say we have this intra range created, we then take the low inside that range and then we trade higher. That's what I'd want to see, especially being at the 4-hour and with no clear sign on the daily time frame to make a reversal. Like, we just had a huge up close. You have to be bullish. The other thing is we could immediately rebalance. We could come down, like say sweep previous week high or all-time highs now, come down, leave a huge wick, and then closes like a consolidation candle. I do believe next week, just because of, look at that, like this is a large range expansion. 2,000 handles, just about. Large range expansion. So what does that mean? Price is either probably going to continue or it is going to reaccumulate. If it reaccumulates, yes, that's not necessarily good conditions to trade inside, but it's good information. If we have a weekly candle close as a consolidation candle, so say we sweep the high, come back down, close within the range, we would then want to see next week take the range low and then look to, so when I say that, I mean like open, say we gap lower as manipulation. So say we've gapped and that's our open. We then want to see price trade, take the low inside of our gap and then look to almost displace, or even say up close, but inside the body range, and then have the next week reluctantly be able to get down to that low, maybe even resweep the low it took and then trade higher actually have some daily displacement. But with expansions like these, you can see here, expansions like these require reaccumulation. So this is almost what I'm expecting for this week, especially with such poor delivery of news. We have like one lot of news on Tuesday, and for me, that's not even that high. Like, it's high impact, it's red folder. But is that actually like going to drive the market like a CPI or FOMC would? No, it won't. So the likelihood for this week, in my opinion, is that we accumulate. I want to see some form of manipulation and then a distribution higher. It would be nice if we can get a daily time frame to have a daily reversal sequence in alignment with that on like Monday, Tuesday. Say then we just can keep chopping up. Say even Thursday can manipulate, and then even Friday can start to make our reversal. Then next week we can come into the market and then know that we are going to create some form of expansion, if that makes sense. But yeah, I think I'm pretty happy with calling it there for the moment. Again, for me personally, I'm just going to wait for more information, especially because I intraday scalp. I use the higher time frame to tell me where price should be drawing to on the daily, and then I use that to align that with the session timeframes and so on and so on. I want more information. We've got clean relative equal highs here. I know we've got a SMT from high to high, but it means nothing when price can gap upon a new week open. So I want to see where price reacts off of and where it trades to. So in the meantime, I hope you guys have a blessed day. I hope you guys had a blessed week. Hope you guys enjoyed this video. It's a lot more EDU than it's narrative building, to be honest. It's not EDU, it's narrative building. And for you guys, that is imperative if you ever want to succeed as a profitable trader, to build a narrative, build a couple different like frameworks of price, like why price should do it, how it should do it, and then just seeing or reacting to what price does. Because again, that's just the most important thing, is having a narrative and seeing if price confirms or denies your narrative, which is kind of the sort of thing you like to see. But regardless, we are going to call it there. I think that should cover everything. Just hit the like, hit the sub button, hit the noties, because these videos are pretty source and like at the moment I always post on my story. But regardless, leave a comment if you've learned something or if you have questions. Anytime there's a comment, I'm happy to answer it. Especially regardless of the question, I want to answer it. It means that other people that click on the video, they might have the same question and they can answer it, or they can see the answer in the comment section. So that makes my life a bit easier. But regardless, hope you guys have a good night, and I will see you all tomorrow probably, but we'll see what price does, because I'm not sure I want to be trading tomorrow. But yeah, well, we will call it there. Peace out.